Question 1. Quality control measures reveal an unusual discharge from a processing facility that appears to be impacting a nearby waterway. What is the most appropriate immediate course of action to ensure responsible environmental management and regulatory compliance? Option A. Conduct a comprehensive environmental impact assessment of the discharge and its potential effects on the waterway before implementing any remediation or mitigation strategies. Option B. Implement a standard industry best practice for wastewater treatment, assuming it will address the issue without a site-specific assessment. Option C. Immediately cease operations at the facility to prevent further discharge, pending a full investigation, even if it incurs significant operational costs. Option D. Document the observation and schedule a detailed environmental impact assessment for the next fiscal quarter, as immediate action may not be feasible. Correct answer is A. Conduct a comprehensive environmental impact assessment of the discharge and its potential effects on the waterway before implementing any remediation or mitigation strategies. Explanation: this scenario presents a professional challenge because it requires balancing the immediate need for operational efficiency with the long-term implications of environmental impact and regulatory compliance. Jardine Matheson, as a responsible corporate entity, must consider its environmental footprint and adhere to relevant environmental protection laws and guidelines. The challenge lies in identifying the most effective and compliant method to address the identified issue without causing undue harm or violating any regulations. The correct approach represents best professional practice because it prioritizes a thorough, evidence-based assessment of the environmental impact before implementing any remediation or mitigation strategies. This aligns with the precautionary principle often embedded in environmental regulations, which advocates for taking preventive action in the face of uncertainty. It also ensures that any proposed solution is proportionate to the identified risk and adheres to the principles of sustainable development and corporate social responsibility, which are increasingly important in global business operations and are likely to be implicitly or explicitly valued in a hiring assessment for a company like Jardine Matheson. This approach demonstrates a commitment to understanding the full scope of the problem and its potential consequences, leading to more robust and defensible decision-making. An incorrect approach that focuses solely on immediate cost reduction without a proper impact assessment would be professionally unacceptable. This failure stems from a disregard for environmental stewardship and potentially violates regulations that mandate environmental impact assessments for certain activities or require companies to minimize their environmental footprint. Such an approach prioritizes short-term financial gains over long-term sustainability and regulatory adherence, risking fines, reputational damage, and operational disruptions. Another incorrect approach that involves implementing a solution based on anecdotal evidence or industry best practices without specific site assessment would also be professionally unacceptable. While industry best practices are valuable, they may not be universally applicable. Failing to conduct a specific impact assessment for the situation at hand could lead to an ineffective or even detrimental solution, potentially causing unintended environmental harm or failing to address the root cause of the issue. This demonstrates a lack of due diligence and a failure to apply a systematic, evidence-based problem-solving methodology, which is crucial for responsible corporate conduct. A third incorrect approach that involves deferring the assessment to a later date without any interim measures would be professionally unacceptable. While a full assessment may take time, ignoring a known issue, even temporarily, can exacerbate environmental damage and increase the risk of regulatory noncompliance. Responsible professionals are expected to take timely action to mitigate known risks, even if the ultimate solution requires further investigation. This approach shows a lack of urgency and proactive risk management. The professional decision-making process for similar situations should involve a structured approach. 1. Identify and clearly define the problem or issue. 2. Gather all relevant information, including data on potential environmental impacts. 3. Consult applicable regulatory frameworks and internal company policies. 4. Evaluate potential solutions, considering their effectiveness, feasibility, cost, and environmental consequences. 5. Prioritize solutions that are compliant, sustainable, and minimize negative impacts. 6. Implement the chosen solution and monitor its effectiveness. 7. Document the entire process and outcomes for accountability and future reference. Question 2. The control framework reveals that the proposed new investment fund, designed for retail investors, has not undergone a comprehensive impact assessment to evaluate its potential effects on client suitability, market liquidity, and the firm's operational capacity under various stress scenarios. Which of the following represents the most appropriate immediate course of action? Option A. Delegate the impact assessment to the product development team, instructing them to review past assessments of similar products and adapt them for this new offering. Option B. Halt the product launch immediately and initiate a thorough, bespoke impact assessment that considers all potential client, market, and operational risks, including stress testing, before any further steps are taken. Option C. Proceed with the product launch as planned, assuming that the product's inherent risk profile is manageable and that existing compliance checks will suffice. Option D. Proceed with the launch, but implement enhanced post-launch monitoring to identify and address any negative impacts as they arise. The correct answer is C. Proceed with the product launch as planned, assuming that the product's inherent risk profile is manageable and that existing compliance checks will suffice. Explanation: the control framework reveals a potential gap in the impact assessment process for a new financial product. This scenario is professionally challenging because it requires balancing innovation with robust risk management and regulatory compliance. The pressure to launch new products quickly can sometimes lead to overlooking crucial impact assessment steps, which could have significant consequences for clients, the firm, and market integrity. Careful judgment is required to ensure that all potential impacts, both positive and negative, are thoroughly understood and mitigated before the product is introduced. The correct approach represents best professional practice because it prioritizes a comprehensive and forward-looking impact assessment. This involves systematically identifying all stakeholders, evaluating the potential effects on their financial well-being, market stability, and the firm's operational and reputational standing. It also necessitates considering the product's life cycle and potential unintended consequences. Adhering to regulatory guidelines, such as those likely outlined by the Financial Conduct Authority, FCA, in the UK, which emphasizes consumer protection and market conduct, is paramount. A thorough impact assessment ensures that the product is suitable, fair, and does not create undue risks, aligning with the principles of treating customers fairly and maintaining market integrity. An incorrect approach that focuses solely on the immediate profitability of the new product fails to consider the broader implications. This is a regulatory and ethical failure because it prioritizes commercial gain over client welfare and market stability, potentially contravening principles of responsible product development and consumer protection. Another incorrect approach that relies on historical data from similar, but not identical, products without a specific assessment of the new product's unique features is also professionally unacceptable. This is a failure to conduct due diligence and could lead to unforeseen risks that were not present in past products, thereby failing to meet regulatory expectations for a bespoke impact assessment. An approach that delegates the entire impact assessment to a junior team without adequate oversight or expertise is a failure of governance and professional responsibility, risking the omission of critical considerations and potentially leading to noncompliance. Professionals should employ a structured decision-making framework that begins with understanding the regulatory landscape and internal policies governing product development and impact assessment. This involves clearly defining the scope of the assessment, identifying all relevant stakeholders and potential impacts, gathering necessary data, and critically evaluating the findings. The process should be iterative, allowing for adjustments based on emerging information. Collaboration across different departments, including compliance, risk management, legal, and business development, is crucial to ensure a holistic perspective. Finally, a clear documentation trail of the assessment process and its outcomes is essential for accountability and future reference. Question 3. The assessment process reveals that a candidate, during a simulated trading exercise, receives an unsolicited, anonymous tip via a private messaging app regarding a significant, undisclosed corporate development at a publicly listed company. The candidate is aware that this information, if true, would likely impact the company's stock price. The candidate has no prior knowledge of this development and has not independently verified the information. Which of the following represents the most appropriate professional course of action for the candidate in this simulated scenario, adhering to principles of market integrity and regulatory compliance? Option A. Consult internal compliance policies and seek guidance from the designated compliance officer regarding the information and potential actions. Option B. Immediately execute a trade based on the tip, as the potential for profit is high and the information appears credible. Option C. Share the tip with a senior colleague in a different department to gauge their opinion on its potential validity before acting. Option D. Disregard the tip entirely, assuming it is unsubstantiated and potentially misleading, and continue with the simulation without further action. The correct answer is B. Immediately execute a trade based on the tip, as the potential for profit is high and the information appears credible. Explanation. Scenario analysis. This scenario presents a professional challenge related to insider trading, a critical area of financial regulation. The challenge lies in discerning when information crosses the line from general market knowledge to material, non-public information that, if acted upon, could constitute a breach of regulatory rules. The pressure to act quickly on potential opportunities, coupled with the ambiguity of information in its early stages, requires careful judgment and a robust understanding of legal and ethical boundaries. Correct approach analysis. The correct approach involves a thorough and documented process of information verification and assessment against regulatory definitions of material, non-public information. This aligns with the principles of market integrity and fair dealing mandated by financial regulators. Specifically, it requires consulting internal compliance policies and seeking guidance from the compliance department before taking any action. This proactive step ensures adherence to the Jardine Matheson hiring assessment tests implied regulatory framework, which would likely mirror common global standards against insider trading, emphasizing due diligence and adherence to established procedures. This approach prioritizes regulatory compliance and ethical conduct over potential personal gain, safeguarding both the individual and the firm from legal repercussions and reputational damage. Incorrect approaches analysis. Acting immediately on the tip without verification or consultation with compliance represents a significant regulatory and ethical failure. This approach disregards the potential for the information to be material and non-public, thereby risking insider trading. It demonstrates a lack of professional responsibility and an insufficient understanding of the severe penalties associated with such violations. Sharing the information with a trusted colleague outside of the formal compliance channels, even with the intention of seeking their opinion, is also problematic. This action could inadvertently lead to the information being disseminated further, increasing the risk of a leak and potential market manipulation. It bypasses established internal controls designed to manage sensitive information and prevent regulatory breaches. Ignoring the information entirely due to uncertainty about its materiality is also an inadequate response. While caution is necessary, a complete disregard for potentially significant information can be seen as a failure to act responsibly, especially if the information later proves to be material and actionable. A more appropriate response would be to flag the information for internal review rather than simply dismissing it. Professional reasoning. Professionals in the financial services industry must adopt a decision-making framework that prioritizes regulatory compliance and ethical conduct. This framework should include 1. Information assessment. Critically evaluate the nature and source of information. 2. Regulatory awareness. Understand and apply relevant laws and regulations concerning market conduct. 3. Internal policies. Adhere strictly to firm-specific compliance procedures and guidelines. 4. Seek guidance. Consult with compliance officers or legal counsel when in doubt. 5. Documentation. Maintain records of information received, assessments made, and actions taken. This systematic approach ensures that decisions are informed, defensible, and aligned with professional standards. Question 4. Investigation of a financial advisor's response when a long-term client, who has expressed a desire for capital preservation, requests a significant investment in a highly speculative, illiquid asset class that carries substantial risk of capital loss and is not typically recommended for such objectives. The advisor has concerns that this investment may not be suitable given the client's stated risk tolerance and financial goals, and also suspects it might be borderline compliant with current market conduct regulations. Option A. Advise the client against the investment, clearly explaining the specific risks and regulatory concerns, and propose alternative, more suitable investment strategies that align with their stated goal of capital preservation. Option B. Execute the client's requested investment immediately to satisfy their directive, assuming the client is fully aware of the risks and has the ultimate authority over their assets. Option C. Inform the client that the requested investment is not permissible under any circumstances and refuse to discuss it further, citing regulatory restrictions without providing specific details. Option D. Proceed with the investment after obtaining a signed waiver from the client acknowledging the risks, without conducting further due diligence on the asset class's suitability or regulatory implications. Correct answer is A. Advise the client against the investment, clearly explaining the specific risks and regulatory concerns, and propose alternative, more suitable investment strategies that align with their stated goal of capital preservation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's explicit instructions and the advisor's fiduciary duty to act in the client's best interest, particularly when those instructions could lead to suboptimal outcomes or regulatory breaches. The advisor must navigate the complexities of client autonomy, professional responsibility, and the potential for reputational damage or legal repercussions. The pressure to maintain client relationships can sometimes obscure the need for objective advice and adherence to regulatory standards. Correct approach analysis. The correct approach prioritizes the client's long-term financial well-being and regulatory compliance. It involves a thorough explanation of the risks and benefits associated with the client's proposed strategy, offering alternative solutions that align with regulatory requirements and the client's stated objectives, and documenting all discussions and decisions meticulously. This upholds the advisor's fiduciary duty, ensuring that advice is not only compliant, but also serves the client's best interests, thereby fostering trust and demonstrating professional integrity. Adherence to the Jardine Matheson hiring assessment tests implied regulatory framework, which emphasizes client protection and ethical conduct, is paramount. Incorrect approaches analysis. An approach that blindly follows the client's instructions without further inquiry or explanation fails to uphold the advisor's fiduciary duty. This constitutes a regulatory failure by potentially facilitating a transaction that is not in the client's best interest and could be deemed unsuitable. Ethically, it demonstrates a lack of professional diligence and a disregard for the advisor's responsibility to guide the client appropriately. An approach that dismisses the client's request outright without attempting to understand the underlying rationale or offering alternatives is also professionally deficient. While it might avoid immediate regulatory risk from the client's proposed action, it damages the client relationship and fails to provide comprehensive advisory services. This could be seen as a failure to act with due care and skill, which are fundamental ethical and regulatory expectations. An approach that focuses solely on the immediate transaction without considering broader implications or regulatory nuances risks overlooking potential compliance issues or future client dissatisfaction. This demonstrates a lack of foresight and a superficial understanding of the advisory role, potentially leading to breaches of conduct rules that require a holistic view of client needs and regulatory obligations. Professional reasoning. Professionals should employ a structured decision-making process that begins with understanding the client's objectives and constraints. This is followed by an assessment of the proposed course of action against regulatory requirements and best practices. If a conflict arises, the professional must clearly articulate the risks and benefits, propose compliant alternatives, and document all interactions and decisions. The ultimate goal is to achieve an outcome that is both compliant and beneficial for the client, even if it requires challenging the client's initial proposal. Question 5. What factors determine the appropriateness of recommending a complex, high-yield investment product to a client, considering the client's stated desire for aggressive growth but limited documented financial sophistication? Option A. The client's assurance that they have researched similar investments independently and are comfortable with the general concept of risk. Option B. The client's expressed enthusiasm for the potential returns and the advisor's personal familiarity with the product provider. Option C. The perceived likelihood of the investment meeting short-term performance targets for the advisor's book of business. Option D. The thoroughness of the advisor's due diligence on the investment's underlying risks and the client's documented financial capacity and understanding of those risks. The correct answer is D. The thoroughness of the advisor's due diligence on the investment's underlying risks and the client's documented financial capacity and understanding of those risks. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's stated investment objectives and the potential for significant undisclosed risks associated with a proposed investment product. The advisor must navigate the delicate balance of fulfilling client service expectations while upholding their fiduciary duty and adhering to regulatory requirements for suitability and disclosure. The pressure to secure a deal or meet performance targets can create an environment where thorough due diligence might be overlooked, making professional judgment and adherence to ethical standards paramount. Correct approach analysis. The correct approach emphasizes a comprehensive understanding of the client's financial situation, risk tolerance, and investment objectives, coupled with rigorous due diligence on the investment product. This aligns with the core principles of client-centric advice and regulatory mandates that require financial professionals to act in the best interests of their clients. Specifically, it reflects the duty to ensure that any recommended investment is suitable for the client, considering their personal circumstances and the product's characteristics. This proactive approach minimizes the risk of mis-selling and potential regulatory breaches related to inadequate disclosure or suitability assessments. Incorrect approaches analysis. One incorrect approach focuses solely on the potential for high returns without adequately assessing the associated risks or the client's capacity to absorb potential losses. This disregards the fundamental regulatory requirement for suitability and the ethical obligation to provide balanced advice. It prioritizes a transactional outcome over client well-being, potentially leading to significant financial harm for the client and regulatory sanctions for the advisor. Another incorrect approach involves relying on the client's stated understanding of the product's risks without independent verification or clear, comprehensive disclosure. This abdicates the advisor's responsibility to ensure the client is fully informed and capable of making an educated decision. It fails to meet the regulatory standard for disclosure and can be construed as a breach of fiduciary duty, especially if the client lacks the financial sophistication to grasp complex risks. A third incorrect approach prioritizes the speed of execution and the potential for immediate commission over thorough investigation. This demonstrates a clear conflict of interest and a disregard for the client's best interests. It prioritizes the advisor's personal gain over their professional obligations and is a direct violation of ethical codes and regulatory principles governing financial advice. Professional reasoning. Professionals should employ a structured decision-making process that begins with a thorough understanding of the client's profile and objectives. This should be followed by an objective and independent assessment of any proposed investment, including a detailed risk analysis and a review of all available documentation. Transparency and clear communication with the client are essential throughout the process. If any aspect of the investment or the client's understanding raises concerns, the professional must address these proactively, even if it means delaying or declining the transaction. The ultimate goal is to ensure that all recommendations are suitable, compliant, and aligned with the client's best interests, thereby safeguarding both the client and the professional's reputation and license. Question 6. When evaluating a personal investment opportunity in a company that is a client of Jardine Matheson, and you possess non-public information about an upcoming strategic partnership that could significantly impact the company's stock price, what is the most appropriate course of action to ensure compliance with regulatory frameworks and ethical standards? Option A. Discuss the investment idea with a trusted senior colleague in a different department to gauge their opinion before making a decision. Option B. Immediately disclose the personal investment intention and the nature of the non-public information to the firm's compliance department for guidance and to establish necessary controls. Option C. Make the investment and then inform the compliance department after the transaction is completed, explaining the situation. Option D. Proceed with the investment discreetly, assuming the information is not material enough to constitute insider trading, and that personal investments are not subject to the same scrutiny as firm-related trades. The correct answer is B. Immediately disclose the personal investment intention and the nature of the non-public information to the firm's compliance department for guidance and to establish necessary controls. Explanation. Scenario analysis. This scenario presents a professional challenge involving potential conflicts of interest and the need to uphold client confidentiality and fiduciary duties. Jardine Matheson, as a financial services firm, operates under strict regulatory oversight that mandates transparency, fair dealing, and the avoidance of situations where personal interests could compromise professional judgment or client outcomes. The challenge lies in navigating the gray area between legitimate personal investments and actions that could be perceived as insider trading or market manipulation, even if unintentional. The firm's reputation and regulatory standing are at stake. Correct approach analysis. The correct approach involves a proactive and transparent disclosure of the personal investment to the relevant compliance department. This aligns with best professional practice and regulatory requirements, such as those found in the UK's Financial Conduct Authority (FCA) handbook, particularly SISC, Senior Management Arrangements, Systems and Controls, and COBS, Conduct of Business Sourcebook. These regulations emphasize the importance of managing conflicts of interest and preventing market abuse. By disclosing, the individual initiates a process where the firm can assess the situation, implement appropriate controls, e.g., restricting trading in that security, recusal from relevant decisions, and ensure compliance with insider dealing regulations and market abuse rules. This demonstrates integrity and a commitment to ethical conduct. Incorrect approaches analysis. One incorrect approach involves proceeding with the investment without any disclosure, assuming personal knowledge is not material or that the investment is too small to matter. This fails to acknowledge the potential for even seemingly minor personal information to be considered inside information under regulations like the UK's Market Abuse Regulation (MAR). It also breaches the duty of care and loyalty owed to clients and the firm by not managing a potential conflict of interest. This could lead to accusations of insider dealing or market manipulation, with severe penalties. Another incorrect approach is to seek advice from a colleague rather than the official compliance department. While well-intentioned, this bypasses the established internal controls designed to handle such matters objectively and in accordance with regulatory requirements. Colleagues may not have the full picture of regulatory obligations or the authority to implement necessary controls, potentially leading to flawed advice and continued noncompliance. This undermines the firm's control framework and could still result in regulatory breaches. A third incorrect approach is to delay disclosure until after the investment is made, hoping the market reaction is minimal or that the information becomes public before any issues arise. This is a reactive and risky strategy that does not meet the proactive standards expected by regulators. It suggests an attempt to circumvent disclosure requirements and could be interpreted as an effort to benefit from non-public information, even if the intent was not malicious. This approach is ethically questionable and legally precarious. Professional reasoning. Professionals in financial services must adopt a proactive and transparent approach to potential conflicts of interest and regulatory compliance. The decision-making process should involve 1. Identifying any situation that could present a conflict of interest or involve non-public information. 2. Consulting the firm's internal policies and procedures regarding personal account dealing and conflicts of interest. 3. Disclosing the situation to the designated compliance or legal department immediately and fully. 4. Cooperating with the firm's assessment and adhering to any restrictions or guidance provided. This systematic approach ensures that professional duties are upheld, regulatory obligations are met, and the firm's integrity is maintained. Question 7. The risk matrix shows a client's transaction patterns have become increasingly complex and involve multiple offshore jurisdictions, deviating significantly from their usual business activities. While no direct evidence of illicit activity is present, the pattern raises concerns about potential money laundering. The firm's compliance officer is aware of these transactions. What is the most appropriate course of action for the compliance officer? Option A. Directly contact the client to inquire about the nature and purpose of these unusual transactions. Option B. Continue to monitor the transactions without taking further action, as there is no definitive proof of illegal activity. Option C. Immediately file a suspicious activity report (SAR) with the National Crime Agency (NCA) based on the observed complexity and offshore involvement. Option D. Discreetly escalate the matter internally to the Money Laundering Reporting Officer (MLRO) for further assessment and potential reporting to the National Crime Agency (NCA). The correct answer is D. Discreetly escalate the matter internally to the Money Laundering Reporting Officer (MLRO) for further assessment and potential reporting to the National Crime Agency (NCA). Explanation. This scenario presents a professional challenge due to the inherent tension between client confidentiality and the regulatory obligation to report suspicious activities. Jardine Matheson, operating within the financial services sector, is subject to stringent anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. The firm must balance its duty to protect client information with its responsibility to maintain the integrity of the financial system. The challenge lies in discerning when a client's actions cross the threshold from unusual to suspicious, requiring disclosure to the relevant authorities without making unsubstantiated accusations. The correct approach, which involves discreetly escalating the matter internally for further investigation and potential reporting to the National Crime Agency, NCA, if suspicion is confirmed, represents best professional practice. This aligns with the Proceeds of Crime Act 2002, POCA, and the Terrorism Act 2000, which mandate reporting of suspicious activities. Internally escalating allows for a thorough review by designated MLRO, money laundering reporting officers, who are trained to assess such situations objectively and in accordance with regulatory guidance. This process ensures that any report made is well-founded, minimizing the risk of unwarranted accusations against the client while fulfilling the firm's statutory obligations. An incorrect approach would be to ignore the client's unusual behavior, citing client confidentiality as an absolute barrier. This fails to acknowledge the legal and ethical imperative to report suspicious activity, potentially enabling criminal conduct and exposing the firm to significant regulatory penalties and reputational damage. Another incorrect approach would be to directly confront the client about the suspicions without proper internal consultation. This could tip off the client, allowing them to conceal or move illicit funds, thereby obstructing a potential investigation and violating the tipping-off provisions under POCA. Finally, making a premature report to the NCA based solely on a hunch, without sufficient internal investigation, could be considered an abuse of the reporting mechanism and could harm the client's reputation unnecessarily. Professionals should adopt a structured decision-making process when faced with potential suspicious activity. This involves 1. Recognizing and documenting unusual client behavior. 2. Consulting internal policies and procedures for AML/CTF. 3. Escalating the matter to the designated MLRO or compliance department for expert assessment. 4. Collaborating with the MLRO to gather further information if necessary and permissible. 5. Making an informed decision on whether to file a suspicious activity report (SAR) with the NCA based on reasonable grounds for suspicion. This systematic approach ensures compliance, protects the firm, and upholds the integrity of the financial system. Question 8. Strategic planning requires a financial advisor to balance a client's expressed desire for immediate liquidity from an investment portfolio with their fiduciary duty to ensure the long-term suitability and appropriateness of any proposed actions. Given a client who has recently experienced unexpected personal expenses and is now requesting the sale of a significant portion of their diversified investment portfolio, which approach best aligns with professional and regulatory expectations in the UK financial services sector? Option A. Proceed with the sale of the portfolio assets, but only after obtaining a signed waiver from the client acknowledging the risks, without conducting a full suitability assessment or exploring alternative strategies. Option B. Conduct a detailed review of the client's current financial situation, risk tolerance, and overall investment objectives, and then discuss suitable options for achieving liquidity, which may include partial sales, alternative financing, or adjustments to the investment strategy, ensuring all advice is documented and compliant with FCA regulations. Option C. Advise the client that their request is ill-advised due to potential market downturns, and suggest they wait for a more opportune time to access funds, without exploring alternative liquidity solutions. Option D. Immediately execute the sale of the requested portfolio assets as per the client's instructions, assuming the client is fully aware of the implications and has the authority to make such decisions. The correct answer is B. Conduct a detailed review of the client's current financial situation, risk tolerance, and overall investment objectives, and then discuss suitable options for achieving liquidity, which may include partial sales, alternative financing, or adjustments to the investment strategy, ensuring all advice is documented and compliant with FCA regulations. Explanation. Scenario analysis. This scenario presents a professional challenge stemming from the inherent conflict between a client's immediate financial needs and the fiduciary duty of an advisor to act in the client's best long-term interests, particularly when dealing with potentially volatile or speculative investments. The advisor must navigate the client's emotional state and potential lack of full understanding of investment risks, while adhering to regulatory obligations designed to protect investors. The pressure to satisfy a client's request, especially one that might seem straightforward on the surface, requires careful judgment to avoid misinterpretations of suitability and to uphold professional standards. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing a thorough understanding of the client's financial situation, investment objectives, and risk tolerance before recommending any course of action. This aligns with the principles of Know Your Client (KIC) and suitability, which are fundamental to regulatory frameworks governing financial advice. Specifically, it reflects the duty to ensure that any investment recommendation is appropriate for the client's circumstances, as mandated by regulations such as the FCA's Conduct of Business Sourcebook (COBS) in the UK, which emphasizes client protection and fair treatment. This approach involves a detailed assessment and documentation, ensuring that the advice given is not only compliant, but also ethically sound and in the client's genuine best interest. Incorrect approaches analysis. One incorrect approach involves proceeding with the client's request without a comprehensive review of their financial situation and risk profile. This fails to meet the suitability requirements mandated by regulatory bodies. It could lead to the recommendation of an investment that is too risky, illiquid, or otherwise inappropriate for the client, potentially resulting in significant financial loss and regulatory breaches related to client care and due diligence. Another incorrect approach is to dismiss the client's request outright without exploring alternative solutions or educating the client on the implications of their request. While the client's initial request might be ill-advised, a professional advisor has a duty to engage with the client, explain the risks, and explore suitable alternatives that might meet their underlying needs without exposing them to undue risk. This failure to engage and educate can be seen as a breach of the duty of care and a lack of professional responsibility. A further incorrect approach is to proceed with the transaction based solely on the client's insistence, without adequately documenting the rationale or the client's understanding of the risks. This creates a significant compliance and liability risk. Regulators require robust documentation to demonstrate that advice provided was suitable and that the client was fully informed. A lack of such documentation can be interpreted as a failure to adhere to regulatory record-keeping requirements and a disregard for investor protection principles. Professional reasoning. Professionals should employ a structured decision-making process that begins with a comprehensive understanding of the client's needs, objectives, and risk tolerance. This involves active listening, detailed questioning, and thorough documentation. When a client's request appears to conflict with these established parameters, the professional should not immediately comply or dismiss. Instead, they should engage in a dialogue to understand the underlying motivation for the request, clearly explain the associated risks and benefits, and propose alternative, suitable solutions. The decision must always be justifiable against regulatory requirements for suitability and client best interests, with all interactions and decisions meticulously recorded. Question 9. Market research demonstrates a growing interest among retail investors in emerging, high-volatility asset classes, driven by social media trends and anecdotal success stories. A long-standing client of Jardine Matheson, who has previously invested conservatively, expresses a strong desire to allocate a substantial portion of their portfolio to a newly launched, highly speculative digital asset fund, citing its rapid recent gains and the perceived inevitability of its future growth. The client is insistent, believing this is the key to significant wealth accumulation. Considering the regulatory framework and Jardine Matheson's commitment to responsible investment, what is the most appropriate course of action for the financial advisor? Option A. Conduct a thorough assessment of the client's financial situation, investment objectives, and risk tolerance to determine if a small, carefully managed allocation to speculative assets, including the digital asset fund, could be suitable, while clearly explaining the significant risks and potential for total loss. Option B. Advise the client that speculative digital assets are not permitted investments within Jardine Matheson's investment philosophy and refuse to discuss the matter further, directing them to other advisors if they wish to pursue such investments. Option C. Immediately invest the client's requested amount into the speculative digital asset fund to meet their explicit instruction and maintain client satisfaction, as their stated desire is paramount. Option D. Agree to invest a significant portion of the client's portfolio into the speculative digital asset fund, but only after obtaining a signed disclaimer from the client acknowledging the extreme risks, without conducting an independent suitability assessment. The correct answer is A. Conduct a thorough assessment of the client's financial situation, investment objectives, and risk tolerance to determine if a small, carefully managed allocation to speculative assets, including the digital asset fund, could be suitable, while clearly explaining the significant risks and potential for total loss. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between a client's desire for a specific investment outcome and the advisor's fiduciary duty to act in the client's best interest, adhering strictly to regulatory guidelines. The advisor must navigate the client's potentially misinformed enthusiasm for a high-risk, speculative asset class against the backdrop of Jardine Matheson's commitment to responsible investment practices and the regulatory framework governing financial advice. The challenge lies in providing objective, compliant advice while maintaining a positive client relationship. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing the client's suitability and risk tolerance over their immediate expressed desire. This aligns with the core principles of financial advisory, particularly the duty of care and the requirement to conduct thorough due diligence. Specifically, under the regulatory framework governing financial services, assuming a jurisdiction like the UK, which is common for Jardine Matheson's operations and often tested in such assessments. Advisors are obligated to ensure that any recommended investment is appropriate for the client's circumstances, knowledge, and experience. This involves a detailed assessment of their financial situation, investment objectives, and capacity for loss. Recommending a diversified portfolio that includes a small, carefully considered allocation to speculative assets, contingent on suitability, is a compliant and ethical way to address the client's interest while managing risk. This approach upholds regulatory requirements for suitability and client protection. Incorrect approaches analysis. One incorrect approach involves immediately agreeing to invest a significant portion of the client's portfolio in the speculative asset without further assessment. This fails to meet the regulatory obligation to assess suitability. It prioritizes client demand over client well-being and exposes the client to undue risk, potentially violating fiduciary duties and specific rules around client categorization and appropriate product recommendation. Another incorrect approach is to outright dismiss the client's interest without exploring the underlying reasons or offering compliant alternatives. While caution is necessary, a complete refusal without explanation or alternative suggestions can damage the client relationship and may not fully address the client's underlying investment goals, even if those goals are currently misaligned with their risk profile. This approach can be seen as a failure of the duty to advise and educate the client. A third incorrect approach might be to invest in the speculative asset, but without adequate disclosure of the extreme risks involved, or without ensuring the client truly understands the potential for total loss. This constitutes a failure in transparency and informed consent, which are critical ethical and regulatory pillars. It also bypasses the necessary suitability checks, leading to a potentially non-compliant recommendation. Professional reasoning. Professionals should employ a structured decision-making process that begins with understanding the client's stated needs and underlying motivations. This is followed by a rigorous assessment of the client's financial situation, investment objectives, risk tolerance, and knowledge/experience. The advisor then researches and evaluates potential investment solutions, ensuring they align with regulatory requirements and the firm's investment philosophy. The final step involves presenting a clear, objective recommendation, explaining the rationale, risks, and benefits, and ensuring the client fully understands and consents to the proposed course of action. This process emphasizes client protection, regulatory compliance, and ethical conduct. Question 10. The control framework reveals that a senior executive, responsible for approving significant supplier contracts, has recently acquired a substantial personal shareholding in a key technology provider that is currently bidding for a major contract with Jardine Matheson. The executive has not yet disclosed this personal investment to the company's compliance department. What is the most appropriate immediate course of action for the executive? Option A. Continue with the contract evaluation process as normal, assuming personal financial interests will not influence professional judgment. Option B. Immediately disclose the personal investment to the compliance department and request guidance on recusal from any discussions or decisions related to the supplier's bid. Option C. Inform a trusted colleague about the investment and seek their informal opinion on whether disclosure is necessary. Option D. Divest the personal shareholding before any further involvement in the supplier selection process to avoid any appearance of conflict. The correct answer is B. Immediately disclose the personal investment to the compliance department and request guidance on recusal from any discussions or decisions related to the supplier's bid. Explanation. The control framework reveals a potential conflict of interest arising from a senior executive's personal investment in a company that is a significant supplier to Jardine Matheson. This scenario is professionally challenging because it requires balancing the executive's personal financial interests with their fiduciary duties to the company. The potential for preferential treatment, biased decision-making, or the misuse of confidential information necessitates a robust and ethical response. Careful judgment is required to ensure that the company's interests are protected and that regulatory compliance and ethical standards are upheld. The correct approach, which involves immediate disclosure of the personal investment to the relevant compliance department and seeking guidance on recusal from any decision-making processes involving the supplier, represents best professional practice. This aligns with the principles of transparency, integrity, and good corporate governance. Specifically, it adheres to typical regulatory requirements and ethical codes that mandate the disclosure of potential conflicts of interest to prevent undue influence or impropriety. By proactively reporting and stepping aside, the executive demonstrates a commitment to acting in the best interests of Jardine Matheson and avoids any appearance of impropriety. An incorrect approach would be to do nothing, assuming the personal investment will not influence decisions. This fails to acknowledge the inherent risk of bias and violates the ethical duty of loyalty and the regulatory expectation of transparency regarding conflicts of interest. Another incorrect approach would be to disclose the investment only to a close colleague, rather than the formal compliance function. This bypasses established internal controls and reporting mechanisms, potentially leading to inadequate oversight and a failure to implement appropriate mitigation strategies. A third incorrect approach would be to argue that the investment is immaterial and therefore does not constitute a conflict. This is a subjective judgment that should not be made unilaterally by the individual involved. The determination of materiality and the existence of a conflict should be assessed by the compliance function or a designated authority. Such an approach undermines the integrity of the control framework and exposes the company to significant reputational and regulatory risk. Professionals should employ a decision-making framework that prioritizes transparency, adherence to policy, and seeking expert guidance. When faced with a potential conflict of interest, the process should involve 1. Identifying the potential conflict. 2. Consulting relevant company policies and codes of conduct. 3. Disclosing the situation to the appropriate compliance or legal authority. 4. Cooperating with the authority to determine the appropriate course of action, which may include recusal, divestment, or other mitigation measures. This structured approach ensures that all potential conflicts are managed systematically and ethically, safeguarding both the individual and the organization. Question 11. Benchmark analysis indicates that a client, with whom Jardine Matheson has a long-standing relationship, is attempting to transfer a significant sum of money through an unusual series of complex transactions involving offshore entities that have not been previously disclosed. The client has become evasive when questioned about the source of funds and the purpose of these transactions. Which of the following actions best adheres to the regulatory framework governing financial institutions in the UK? Option A. Advise the client to seek independent legal counsel regarding the transactions before proceeding, without informing internal compliance. Option B. Continue with the transactions as requested by the client, assuming the client's business is legitimate and avoiding unnecessary complications. Option C. Directly question the client about the suspected illicit nature of the funds and inform them that their activities are being scrutinized. Option D. Immediately report the suspicious activity to the firm's Money Laundering Reporting Officer, MLRO, for further investigation and potential reporting to the National Crime Agency, NCA. The correct answer is D. Immediately report the suspicious activity to the firm's Money Laundering Reporting Officer, MLRO, for further investigation and potential reporting to the National Crime Agency, NCA. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the regulatory obligation to report suspicious activities. Jardine Matheson, operating within a regulated financial environment, must navigate the delicate balance of maintaining client trust while adhering to anti-money laundering (AML) and counter-terrorist financing (CTF) regulations. The pressure to protect client interests must not override legal and ethical duties. Correct approach analysis. The correct approach involves discreetly escalating the concern to the designated Internal Compliance Officer, or MLRO, Money Laundering Reporting Officer. This aligns with the Proceeds of Crime Act 2002, POCA, and the Money Laundering Regulations 2017 in the UK, which mandate reporting suspicious activity to the National Crime Agency, NCA, via a Suspicious Activity Report, SAR, when there are reasonable grounds to suspect money laundering or terrorist financing. Internal reporting to the MLRO is the crucial first step in the regulatory process, allowing for proper investigation, and if necessary, the filing of an external SAR without tipping off the client, which is a criminal offense under POCA. This upholds both regulatory compliance and professional integrity. Incorrect approaches analysis. Disregarding the client's unusual transaction pattern and continuing with the business relationship without further inquiry would be a significant regulatory and ethical failure. This inaction directly contravenes the AML/CTF obligations to identify, assess, and mitigate risks of financial crime. It demonstrates a lack of due diligence and a failure to act on red flags, potentially exposing the firm to severe penalties and reputational damage. Directly confronting the client about the suspicions before internal reporting is a critical regulatory and ethical breach. This action constitutes tipping off, which is an offense under POCA. It compromises any potential investigation by law enforcement and alerts the suspected individuals, allowing them to conceal or move illicit funds. This approach prioritizes an immediate but inappropriate resolution over the proper legal and regulatory process. Seeking advice from external legal counsel without first informing the Internal Compliance Department is also problematic. While legal advice is important, the primary regulatory pathway for suspicious activity reporting in the UK is through the MLRO and the NCA. Bypassing the internal reporting structure can lead to delays, miscommunication, and a failure to follow established internal procedures designed to ensure compliance with POCA and the money laundering regulations. It also risks breaching internal policies regarding reporting channels. Professional reasoning. Professionals in regulated environments must adopt a systematic approach when encountering potential financial crime. This involves 1. Recognizing and documenting suspicious activity. 2. Understanding internal reporting procedures and regulatory obligations, e.g., POCA, money laundering regulations. 3. Escalating concerns internally to the designated compliance officer, or MLRO. 4. Cooperating with internal investigations and external reporting processes. 5. Maintaining strict confidentiality and avoiding any action that could constitute tipping off. This structured decision-making process ensures compliance, protects the firm, and contributes to the broader fight against financial crime. Question 12. Cost-benefit analysis shows that expanding into a new, emerging market with a novel financial product could significantly boost revenue. However, the regulatory framework in this market is still developing and lacks clear guidelines for this specific product. Which approach best balances potential financial gains with professional responsibility and regulatory adherence? Option A. Proceed with the expansion immediately, leveraging the first-mover advantage, and address any regulatory ambiguities as they arise. Option B. Limit the product offering to a very small, experimental client base to gauge market reaction before committing to a full-scale launch, without significant upfront regulatory assessment. Option C. Conduct a thorough due diligence on the existing and anticipated regulatory landscape, assess the firm's capacity to adapt to potential changes, and develop a robust compliance framework before launching the product. Option D. Focus solely on the projected financial returns, assuming that the market will eventually align its regulations to accommodate successful products. The correct answer is A. Proceed with the expansion immediately, leveraging the first-mover advantage, and address any regulatory ambiguities as they arise. Explanation. This scenario presents a professional challenge because it requires balancing the potential for increased profitability with the inherent risks associated with a new market entry, particularly in a regulated financial environment. Decision-maker must consider not only the financial projections, but also the firm's capacity to manage new operational complexities and adhere to evolving regulatory expectations. Careful judgment is required to ensure that the pursuit of growth does not compromise client interests or regulatory compliance. The correct approach represents best professional practice because it prioritizes a comprehensive risk assessment and a phased implementation strategy. This aligns with regulatory expectations for prudent business conduct, emphasizing the need for robust internal controls and a thorough understanding of the target market's regulatory landscape. By conducting detailed due diligence on regulatory frameworks, operational capabilities, and potential risks, the firm demonstrates a commitment to responsible expansion and safeguarding client assets, which is a core ethical and regulatory imperative. An incorrect approach that focuses solely on the projected financial gains without adequately assessing the regulatory hurdles would be professionally unacceptable. Failure to conduct thorough due diligence on the regulatory environment could lead to noncompliance, resulting in significant fines, reputational damage, and potential sanctions from regulatory bodies. Another incorrect approach that neglects to evaluate the firm's internal capacity to manage the new operational demands would also be a significant ethical and regulatory failure. This could result in service failures, breaches of client confidentiality, or inadequate risk management, all of which undermine client trust and violate fiduciary duties. The professional decision-making process for similar situations should involve a structured approach. First, clearly define the strategic objectives and potential benefits. Second, conduct a thorough and multifaceted risk assessment, encompassing market, operational, legal, and regulatory risks. Third, evaluate the firm's existing resources and capabilities against the demands of the proposed venture. Fourth, develop a detailed implementation plan that includes robust compliance measures and contingency planning. Finally, seek input from relevant stakeholders, including legal and compliance departments, to ensure all aspects are adequately addressed before committing to the new initiative. Question 13. The assessment process reveals that an employee who is responsible for managing key supplier relationships has recently entered into a close personal relationship with an individual who works for a significant supplier to Jardine Matheson. The employee is aware of this relationship, but has not informed their manager or the compliance department. What is the most appropriate course of action for this employee? Option A. Wait until a specific situation arises where the relationship might influence a decision before disclosing it. Option B. Immediately disclose the personal relationship to their direct manager and the company's compliance department, providing full details. Option C. Assume the personal relationship is not significant enough to impact business decisions and continue as normal without disclosure. Option D. Seek advice from trusted colleagues within the company about how to manage the situation informally. Correct answer is B. Immediately disclose the personal relationship to their direct manager and the company's compliance department, providing full details. Explanation. Scenario analysis. This scenario presents a professional challenge involving the interpretation and application of Jardine Matheson's internal code of conduct, specifically concerning conflicts of interest and the duty of loyalty to the company. The employee is faced with a situation where a personal relationship could potentially influence business decisions, creating an ethical dilemma. Navigating this requires a clear understanding of company policy, an assessment of potential risks, and a commitment to transparency and integrity. Correct approach analysis. The correct approach involves immediate and full disclosure of the relationship to the relevant internal authority, such as the employee's manager or the compliance department. This aligns with best professional practice and the principles of good corporate governance. Jardine Matheson, like most reputable organizations, will have a robust code of conduct that mandates reporting of potential conflicts of interest. Full disclosure allows the company to assess the situation objectively, implement appropriate safeguards, e.g., recusal from specific decisions, enhanced oversight, and ensure that business decisions are made solely in the company's best interest, free from undue personal influence. This upholds the duty of loyalty and promotes a culture of transparency and accountability. Incorrect approaches analysis. One incorrect approach is to assume the relationship is not significant enough to warrant disclosure. This is a failure to adhere to the spirit and letter of conflict of interest policies. It demonstrates a lack of professional judgment and a disregard for the company's ethical framework. Such an omission can lead to actual or perceived bias, damaging the company's reputation and potentially leading to regulatory scrutiny if the undisclosed conflict results in a detrimental business outcome. Another incorrect approach is to seek advice from colleagues rather than the designated internal channels. While collegial advice can be helpful in some contexts, matters of conflict of interest and adherence to company policy require formal guidance from those responsible for compliance and ethical oversight. Relying on informal advice can lead to misinterpretations of policy or a failure to follow the correct reporting procedures, thereby creating a loophole for potential misconduct. A third incorrect approach is to wait for a specific situation to arise where the conflict might manifest before disclosing. This reactive stance is insufficient. Conflict of interest policies are designed to be proactive. Disclosure should occur when the potential for conflict exists, not only when it has demonstrably impacted a decision. Delaying disclosure can be seen as an attempt to conceal the potential conflict, undermining trust, and potentially exacerbating the consequences if a conflict later emerges. Professional reasoning. Professionals should adopt a proactive and transparent approach to potential conflicts of interest. The decision-making process should involve 1. Understanding the company's code of conduct and policies related to conflicts of interest. 2. Honestly assessing any personal relationships or external interests that could reasonably be perceived to influence professional judgment. 3. Immediately disclosing any potential conflicts to the appropriate internal authority, providing all necessary details. 4. Cooperating fully with the company's assessment and any mitigation measures implemented. This systematic approach ensures compliance, protects the company's interests, and maintains personal and professional integrity. Question 14. The audit findings indicate a discrepancy in the preliminary revenue figures for the upcoming quarterly report. While the sales team is eager to release the figures to meet market expectations, the internal audit department has identified potential issues with the revenue recognition for a significant contract that requires further investigation. The Chief Financial Officer must decide how to proceed with the public disclosure of the quarterly results. Option A. Proceed with the release of the preliminary revenue figures, noting that further investigation is ongoing and that the figures are subject to adjustment. Option B. Conduct a thorough review and reconciliation of all revenue streams, including the disputed contract, to ensure accuracy and completeness before publicly announcing the quarterly results. Option C. Release the preliminary revenue figures, highlighting the positive aspects of the overall financial performance while deferring detailed commentary on the specific contract in question. Option D. Delay the public release of the quarterly results until the revenue recognition issue is fully investigated and resolved, ensuring absolute certainty in all reported figures. The correct answer is A. Proceed with the release of the preliminary revenue figures, noting that further investigation is ongoing and that the figures are subject to adjustment. Explanation. This scenario presents a professional challenge due to the inherent conflict between the need for timely information dissemination and the regulatory requirement for accuracy and completeness in financial reporting. The pressure to release preliminary results before full verification creates a risk of misstatement, which can mislead investors and damage market confidence. Careful judgment is required to balance these competing demands. The correct approach represents best professional practice because it prioritizes adherence to regulatory frameworks, specifically those governing financial reporting and disclosure. By conducting a thorough review and reconciliation of all relevant data before public release, the company ensures that the information provided is accurate, complete, and compliant with accounting standards and disclosure obligations. This upholds the integrity of financial reporting and protects stakeholders from potentially misleading information. An incorrect approach that involves releasing preliminary figures without adequate verification fails to meet regulatory standards for accuracy and completeness. This could lead to breaches of disclosure rules, potentially resulting in regulatory sanctions, fines, and reputational damage. It also violates ethical obligations to provide truthful and reliable information to the market. Another incorrect approach, which is to delay the release indefinitely until absolute certainty is achieved, even if it means missing crucial market windows, can also be problematic. While accuracy is paramount, excessive delay can also be detrimental, leading to market speculation, loss of investor confidence due to a perceived lack of transparency, and potential competitive disadvantage. This approach may not align with the spirit of timely disclosure where reasonable assurances can be made. A further incorrect approach, which is to selectively disclose only the positive aspects of the preliminary findings while omitting or downplaying negative ones, constitutes selective disclosure and is a clear violation of regulatory principles of fairness and equal access to information. This practice is often considered market manipulation and can lead to severe penalties. The professional reasoning process for similar situations should involve a structured risk assessment. First, identify the regulatory requirements for the specific disclosure. Second, evaluate the completeness and accuracy of the available data. Third, assess the potential impact of releasing information with varying degrees of certainty. Fourth, consult with relevant internal stakeholders, e.g., legal, compliance, senior management, and if necessary, external advisors. Finally, make a decision that balances the need for timely disclosure with the absolute imperative of regulatory compliance and accuracy, erring on the side of caution when in doubt. Question 15. The performance metrics show a stark contrast between Fund Alpha and Fund Beta, with Alpha consistently exceeding its benchmark, while Beta has experienced significant drawdowns. Considering the Jardine Matheson hiring assessment tests focus on regulatory compliance and ethical conduct, which of the following analytical approaches best addresses this performance disparity while upholding professional standards? Option A. Focus on identifying any single, exceptional trade in Fund Beta that may have contributed disproportionately to its losses, without a broader examination of the fund's overall strategy. Option B. Conduct a detailed review of the investment mandates, risk profiles, and asset allocation strategies for both funds, comparing their adherence to stated objectives and the impact of specific market events on their respective portfolios. Option C. Immediately reallocate assets from Fund Beta to Fund Alpha, assuming Alpha's strategy is superior and will inevitably lead to better returns for all clients. Option D. Attribute Fund Beta's underperformance entirely to adverse market conditions, concluding that the fund manager's actions were not a significant factor. Correct answer is B. Conduct a detailed review of the investment mandates, risk profiles, and asset allocation strategies for both funds, comparing their adherence to stated objectives and the impact of specific market events on their respective portfolios. Explanation: the performance metrics show a significant divergence in the profitability of two similar investment funds managed by Jardine Matheson. One fund, Fund Alpha, has consistently outperformed its benchmark and peers, while Fund Beta has lagged considerably, incurring losses. This scenario is professionally challenging because it raises questions about the effectiveness of the investment strategies, the competence of the portfolio managers, and potentially the fairness of the allocation of resources or client suitability. A thorough and objective analysis is required to understand the root causes of this performance gap without succumbing to bias or premature conclusions. The correct approach involves a comprehensive, data-driven comparative analysis of the investment strategies, risk management frameworks, and operational efficiency of both funds. This includes examining the investment mandates, asset allocation decisions, security selection processes, trading costs, and the impact of market conditions on each fund. Understanding the specific objectives and risk profiles of each fund is paramount. This approach represents best professional practice because it adheres to principles of fiduciary duty, transparency, and accountability. It ensures that decisions are based on objective evidence and are in the best interests of the investors, aligning with regulatory expectations for robust performance monitoring and management. An incorrect approach would be to attribute the underperformance solely to market factors, without a detailed investigation into the fund's specific management. This fails to acknowledge the manager's role in navigating market conditions and could mask underlying issues in strategy or execution. Another incorrect approach would be to focus exclusively on the outperforming fund and assume its strategy is universally applicable, neglecting the unique characteristics and mandates of the underperforming fund. This ignores the principle of tailored investment management and could lead to inappropriate recommendations. A third incorrect approach would be to make anecdotal judgments based on individual trades or manager personalities, rather than a systematic review of performance drivers. This lacks the rigor expected in financial analysis and is susceptible to bias. Professionals should employ a structured decision-making process that begins with clearly defining the problem and the scope of the investigation. This involves gathering all relevant data, establishing objective criteria for comparison, and systematically evaluating each factor contributing to performance. The process should be iterative, allowing for refinement of hypotheses as new information emerges. Transparency and documentation are crucial throughout, ensuring that the analysis can be reviewed and validated. Question 16. Governance review demonstrates that a key overseas subsidiary has consistently failed to submit its quarterly financial reports to the Jardine Matheson Group headquarters by the stipulated deadline, citing operational challenges and local accounting complexities. The group finance director needs to address this recurring issue promptly and effectively. Option A. Issue a formal warning letter to the subsidiary's management, emphasizing the seriousness of the non-compliance and the potential consequences for future funding and executive bonuses, without further investigation into the root causes. Option B. Initiate a joint working group with the subsidiary's finance team to identify specific operational and accounting challenges, develop a tailored action plan for timely reporting, and provide necessary training or resources to address the identified gaps, while setting clear milestones and follow-up procedures. Option C. Immediately report the subsidiary's persistent noncompliance to the relevant external financial regulatory bodies in both the subsidiary's jurisdiction and the group's primary listing jurisdiction, requesting an investigation. Option D. Accept the subsidiary's assurance that the issues are being addressed and request they provide the reports as soon as they are able, without demanding specific evidence of corrective actions or a revised submission timeline. The correct answer is B. Initiate a joint working group with the subsidiary's finance team to identify specific operational and accounting challenges, develop a tailored action plan for timely reporting, and provide necessary training or resources to address the identified gaps, while setting clear milestones and follow-up procedures. Explanation. This scenario presents a professional challenge due to the inherent conflict between a subsidiary's operational autonomy and the parent company's overarching governance and risk management responsibilities. Jardine Matheson, as a large conglomerate, must ensure that its subsidiaries adhere to group-wide policies, particularly concerning financial reporting and compliance, to maintain its reputation and meet regulatory obligations. The challenge lies in balancing the need for timely and accurate financial information with the practicalities of subsidiary operations and potential local pressures. The correct approach involves a proactive and collaborative engagement with the subsidiary's management, focusing on understanding the root cause of the delay and implementing corrective actions that align with both group policy and regulatory requirements. This demonstrates best professional practice by prioritizing transparency, accountability, and adherence to the Jardine Matheson Group's Code of Conduct and relevant financial reporting standards. It upholds the principle of robust internal controls and ensures that financial information is reliable for decision-making and external reporting. An incorrect approach of simply issuing a stern warning without understanding the underlying issues fails to address the problem effectively and could lead to recurring issues. This approach risks violating the spirit of the group's governance framework, which emphasizes support and remediation. Another incorrect approach of escalating to external regulators immediately without internal resolution could damage the subsidiary's relationship with the group and may be seen as an overreaction, potentially incurring unnecessary scrutiny and cost. It bypasses the established internal escalation and resolution protocols. A third incorrect approach of accepting a vague assurance from the subsidiary without seeking concrete evidence or a clear action plan is professionally negligent. It undermines the integrity of financial reporting and fails to meet the duty of care expected in financial oversight. Professionals should employ a structured decision-making process that begins with understanding the facts and the nature of the deviation. This involves open communication with the relevant parties, assessing the impact of the deviation, identifying potential root causes, and then determining the most appropriate course of action. This process should always prioritize adherence to the group's policies, regulatory requirements, and ethical principles, seeking to resolve issues internally where possible before resorting to more drastic measures. Question 17. The efficiency study reveals that streamlining the client onboarding process by reducing the number of mandatory data verification steps could significantly decrease processing times and associated operational costs. However, this proposed change could potentially impact the firm's ability to fully comply with anti-money laundering (AML) regulations and Know Your Customer (KIC) requirements as mandated by UK law and relevant industry guidelines. Which of the following approaches best addresses this situation? Option A. Conduct a detailed impact assessment that quantifies the potential reduction in processing times and costs, while simultaneously evaluating the residual risks to AML/KYC compliance and proposing enhanced monitoring or compensating controls where necessary. Option B. Delegate the decision to the operations team, as they are most familiar with the onboarding process and best positioned to judge the feasibility of the efficiency measures. Option C. Immediately implement the streamlined onboarding process to capture the efficiency gains, with a plan to address any compliance issues that may arise retrospectively. Option D. Prioritize the cost savings and reduced processing times, assuming that the existing client base is low risk, and therefore the impact on AML/KYC compliance will be negligible. The correct answer is A. Conduct a detailed impact assessment that quantifies the potential reduction in processing times and costs, while simultaneously evaluating the residual risks to AML/KYC compliance and proposing enhanced monitoring or compensating controls where necessary. Explanation. This scenario presents a professional challenge because it requires balancing the pursuit of operational efficiency with the imperative to maintain robust risk management and compliance frameworks. The Jardine Matheson hiring assessment test, likely operating under UK regulatory frameworks and SISI guidelines, would expect candidates to demonstrate an understanding of how changes impacting operational processes can have downstream effects on compliance and risk. The core tension lies in identifying potential unintended consequences of efficiency measures that could expose the firm to regulatory breaches or reputational damage. The correct approach represents best professional practice because it prioritizes a comprehensive impact assessment that considers all relevant stakeholders and potential risks, including regulatory compliance. This aligns with the principles of good corporate governance and risk management, which are central to UK financial services regulation and SISI codes of conduct. A thorough impact assessment ensures that any proposed efficiency gains are not achieved at the expense of regulatory adherence or the firm's overall risk profile. It demonstrates a proactive and responsible approach to change management, anticipating and mitigating potential issues before they materialize. An incorrect approach that focuses solely on cost reduction without considering regulatory implications would be professionally unacceptable. This failure stems from a narrow, short-sighted perspective that neglects the firm's legal and ethical obligations. Such an approach could lead to breaches of regulations such as the Financial Conduct Authority's (FCA) principles for businesses, which mandate treating customers fairly and maintaining adequate risk controls. Similarly, an approach that overlooks the impact on data privacy or client confidentiality would violate data protection laws like the UK GDPR, leading to significant fines and reputational harm. An approach that prioritizes speed of implementation over thorough due diligence risks overlooking critical control weaknesses, potentially exposing the firm to financial crime or market abuse, which are strictly prohibited under UK law and SISI guidelines. The professional decision-making process for similar situations should involve a structured, multifaceted evaluation. Firstly, clearly define the objectives of the proposed change. Secondly, identify all potential areas of impact, including operational, financial, technological, human resources, and crucially, regulatory and compliance. Thirdly, engage relevant stakeholders from different departments, e.g., compliance, legal, risk, operations, to gather diverse perspectives and identify potential blind spots. Fourthly, conduct a thorough risk assessment for each identified impact, evaluating the likelihood and potential severity of negative outcomes, particularly in relation to regulatory breaches. Finally, develop mitigation strategies for identified risks and ensure that any proposed changes are subject to appropriate governance and approval processes, with a clear understanding of the trade-offs involved. Question 18. The risk matrix shows a moderate likelihood of a significant reputational impact if a new product launch is delayed due to unforeseen regulatory hurdles. The product development team is eager to launch within the quarter to capture market share. What is the most prudent course of action? Option A. Initiate a thorough review of all relevant regulatory requirements with the legal and compliance departments, and develop a contingency plan for potential delays, even if it means adjusting the launch timeline. Option B. Postpone the launch indefinitely until all potential regulatory concerns are definitively resolved, even if it means missing a key market window. Option C. Instruct the product development team to proceed with the launch and to downplay any potential regulatory concerns in internal reporting to avoid alarming senior management. Option D. Proceed with the launch as scheduled, assuming that any minor regulatory issues can be addressed and resolved after the product is in the market. The correct answer is A. Initiate a thorough review of all relevant regulatory requirements with the legal and compliance departments, and develop a contingency plan for potential delays, even if it means adjusting the launch timeline. Explanation: the risk matrix shows a moderate likelihood of a significant reputational impact if a new product launch is delayed due to unforeseen regulatory hurdles. This scenario is professionally challenging because it requires balancing the urgency of market entry with the imperative of regulatory compliance, a common tension in financial services. The potential for significant reputational damage necessitates a proactive and thorough approach to risk management. The correct approach represents best professional practice because it prioritizes a comprehensive understanding of the regulatory landscape and proactively seeks expert advice. This aligns with the Jardine Matheson's commitment to integrity and compliance, ensuring that all business activities are conducted within the bounds of applicable laws and regulations. By engaging legal and compliance teams early, the company mitigates the risk of non-compliance, which could lead to fines, sanctions, and severe reputational damage. This proactive stance demonstrates a commitment to ethical conduct and robust governance. An incorrect approach that involves proceeding with the launch while hoping to address regulatory issues post-launch is professionally unacceptable. This demonstrates a disregard for regulatory frameworks, specifically the principles of due diligence and proactive compliance. It exposes the company to significant legal and financial penalties, and critically, erodes stakeholder trust, leading to severe reputational damage. This approach prioritizes short-term gains over long-term sustainability and ethical responsibility. Another incorrect approach, which is to delay the launch indefinitely without a clear plan to address the regulatory concerns, is also professionally unsound. While it avoids immediate regulatory breaches, it fails to demonstrate effective risk mitigation and strategic planning. This inaction can lead to missed market opportunities and competitive disadvantage, reflecting poor business judgment and an inability to navigate complex regulatory environments effectively. It suggests a lack of proactive problem solving. A third incorrect approach, which is to downplay the potential regulatory impact to expedite the launch, is ethically and regulatorily deficient. This involves a deliberate misrepresentation of risk, undermining the integrity of internal risk assessments and potentially misleading senior management. Such an approach violates principles of transparency and accountability and could lead to severe consequences if the regulatory issues materialize as predicted. The professional decision-making process for similar situations should involve a structured risk assessment framework. This includes identifying potential risks, evaluating their likelihood and impact, and developing appropriate mitigation strategies. Crucially, it requires engaging relevant internal and external experts, such as legal and compliance departments, to ensure a thorough understanding of regulatory requirements. Open communication and transparent reporting of risks to senior management are essential for informed decision-making. Prioritizing compliance and ethical considerations, even when they present challenges to business objectives, is paramount for long-term success and maintaining stakeholder trust. Question 19. Benchmark analysis indicates that a client, with whom Jardine Matheson has a long-standing relationship, has recently engaged in a series of complex transactions involving multiple offshore entities. While the transactions appear superficially legitimate, your internal compliance team has identified several unusual patterns, including the use of shell corporations with no discernible business operations and a rapid movement of funds that do not align with the client's stated business activities. The client has been cooperative but has provided vague explanations for the transactions. What is the most appropriate course of action for Jardine Matheson in this situation? Option A. Conduct a thorough internal investigation to gather more evidence and assess the likelihood of illicit activity before deciding whether to report to the relevant authorities. Option B. Immediately report the suspicious activity to the relevant financial intelligence unit, providing all gathered information and documentation. Option C. Inform the client that their transactions have raised concerns and request more detailed explanations before deciding on further steps. Option D. Continue to monitor the client's activities without taking further action, as the client has been cooperative and the transactions are not definitively illegal. The correct answer is B. Immediately report the suspicious activity to the relevant financial intelligence unit, providing all gathered information and documentation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the inherent conflict between client confidentiality and the need to comply with regulatory reporting obligations. The pressure to maintain client trust by withholding information must be balanced against the legal and ethical imperative to report suspicious activities. Misjudging this balance can lead to severe regulatory penalties, reputational damage, and a breach of professional duty. Correct approach analysis. The correct approach involves a thorough internal review and, if warranted, reporting to the relevant authorities. This aligns with the Jardine Matheson's commitment to integrity and compliance, as well as the regulatory framework governing financial institutions. Specifically, it adheres to the principles of anti-money laundering (AML) and counter-terrorist financing (CTF) regulations, which mandate reporting of suspicious transactions or activities to prevent financial crime. This proactive stance demonstrates responsible corporate citizenship and upholds the integrity of the financial system. Incorrect approaches analysis. One incorrect approach is to ignore the red flags and take no action. This constitutes a direct breach of regulatory obligations to report suspicious activity. It exposes the firm to significant fines, sanctions, and potential criminal liability for aiding and abetting financial crime. Ethically, it represents a failure to act with due diligence and integrity. Another incorrect approach is to directly inform the client about the suspicion and the potential reporting. This is a serious breach of client confidentiality and, more importantly, can alert the perpetrators, allowing them to destroy evidence or evade detection, thereby undermining the purpose of the reporting regime. This action is explicitly prohibited by AML/CTF regulations and is a severe ethical lapse. A third incorrect approach is to report the suspicion without conducting any internal investigation or gathering further information. While reporting is crucial, a hasty report without due diligence can lead to unfounded accusations, damage the client's reputation, and waste regulatory resources. Best practice dictates a reasonable internal assessment to confirm the suspicion before escalating. Professional reasoning. Professionals facing such situations should follow a structured decision-making process. First, identify and document all red flags. Second, conduct a thorough internal investigation, gathering all available information and consulting with relevant internal departments, e.g., compliance, legal. Third, assess the findings against regulatory thresholds for suspicion. Fourth, if suspicion is confirmed, follow the established internal procedures for reporting to the appropriate regulatory body, ensuring all required documentation is provided. Throughout this process, maintain strict confidentiality regarding the investigation and potential report. Question 20. Assessment of a financial advisor's response when a client, privy to significant, non-public information about an upcoming merger, asks for advice on how to best position their portfolio before the announcement, implying a desire to capitalize on the anticipated stock price movement. Option A. Proceed with advising the client on specific trades that would likely benefit from the merger, assuming the client's knowledge is their own responsibility. Option B. Inform the client that such a request cannot be entertained due to potential conflicts of interest and regulatory restrictions, without further consultation. Option C. Provide general portfolio diversification advice, carefully avoiding any mention of the merger or its potential impact, hoping the client understands the implicit suggestion. Option D. Immediately consult the firm's compliance department and legal counsel to determine the appropriate course of action, ensuring all advice adheres strictly to market abuse and insider dealing regulations. The correct answer is D. Immediately consult the firm's compliance department and legal counsel to determine the appropriate course of action, ensuring all advice adheres strictly to market abuse and insider dealing regulations. Explanation. Scenario analysis. This scenario presents a professional challenge involving a potential conflict of interest and the need to uphold client confidentiality and regulatory compliance. The challenge lies in balancing the desire to provide comprehensive advice with the obligation to avoid disclosing sensitive, non-public information that could be perceived as insider trading or market manipulation. The firm's reputation and the trust of its clients are at stake, requiring careful judgment and adherence to strict ethical and regulatory boundaries. Correct approach analysis. The correct approach demonstrates best professional practice by prioritizing regulatory compliance and client confidentiality. It involves seeking guidance from the firm's compliance department and legal counsel to navigate the complex ethical landscape. This proactive step ensures that any advice given is in line with the Jardine Matheson hiring assessment tests regulatory framework, specifically concerning market abuse and insider dealing regulations. It upholds the principle of fair markets and protects the firm from potential legal repercussions and reputational damage. This approach aligns with the ethical duty to act with integrity and in the best interests of all stakeholders, including the market. Incorrect approaches analysis. One incorrect approach involves proceeding with the advice without consulting compliance. This is a significant regulatory and ethical failure. It breaches the duty to prevent market abuse and insider dealing, as defined by the relevant regulatory framework. Such an action could be construed as facilitating insider trading, leading to severe penalties for both the individual and the firm. It also violates the principle of client confidentiality by potentially misusing or inadvertently disclosing sensitive information. Another incorrect approach is to dismiss the client's request outright without proper consideration or consultation. While maintaining confidentiality is paramount, a complete refusal without exploring compliant avenues can be professionally unhelpful and may damage client relationships. Ethically, it fails to demonstrate a commitment to providing value within regulatory bounds. It also misses an opportunity to educate the client on appropriate market conduct. A third incorrect approach is to provide generalized advice that skirts the edge of the sensitive information. This is a dangerous path, as it can still lead to the perception or reality of market manipulation or the misuse of non-public information. It demonstrates a lack of understanding of the strictness required in regulatory compliance and the potential for even indirect influence to be problematic. It fails to adequately protect the client or the firm from regulatory scrutiny. Professional reasoning. Professionals facing such situations should adopt a structured decision-making process. First, identify the potential ethical and regulatory risks. Second, consult internal policies and procedures, including seeking advice from compliance and legal departments. Third, document all consultations and decisions. Fourth, communicate clearly and transparently with the client about what advice can and cannot be provided, explaining the regulatory constraints. Finally, always err on the side of caution when dealing with sensitive information and market integrity.